Thank you very much. Yes, thanks very much for coming this afternoon, guys. We are going to talk about the opportunities that investors have today using ETFs. What are we going to sort of focus on? I'm just going to give a very brief introduction to ETFs. Who knows what an ETF is? Put up your hands. So quite a few people already, that's great. And who has invested in an ETF before? So again, a few people here, that's great. There are some people that this should hopefully be a good sort of educational session. And then we're going to look at 3 ETFs in particular, focusing on the SPDR gold shares that you've heard a lot about today. So what is an exchange traded fund? It's a pretty simple product at the end of the day. It's a mutual fund or a unit trust. The only difference really is that it trades on a stock exchange. So it's a pooled fund, trades on a stock exchange. The expenses tend to be significantly lower than traditional mutual funds though. As we'll see later, our SPDR S&P 500 ETF has a total expense ratio of 9 basis points. So you give us $100, we charge you 9 cents to manage that. When you compare that to a mutual fund, it may charge you 1%, 1.5%. There may be a sales commission as well. ETFs really provide a very cost-effective way of investing in the market. So they can be bought at any time during the day on the local stock exchange. They are, by their very nature, diverse products. So we've heard a bit about an option strategy on a couple of securities. ETFs are probably the exact opposite of that, in that they're very diversified. You're trying to own the entire market or a segment of the market or an asset class such as gold. They can be bought and sold on margin, however, as well, should that be of interest. Now, how big is the global ETF market today? In an industry such as finance, it quite often doesn't sort of make a good name for itself with product development. ETFs are one example of a fantastic product that has really served investors well. Today, the industry is over 3 trillion assets. So as well as retail investors buying ETFs, you have the most sophisticated investors in the world. So this is a vehicle that has gained acceptance around the world by both small investors and large investors. A bit about SPDR ETFs and State Street Global Advisors. So we developed the first ETF back in the early 90s, the SPDR S&P 500. Who's heard of that index, by the way? So a few people. So an ETF that invests in US equities. And today we have around about 400 or over 400 billion in ETF assets. So again, if you give us your money to manage, your money is managed alongside the largest investors in the world. So let's look at the market environment year to date. So it's been a pretty ugly start to the year, I think we would say. So hopefully we've got a light here. So we're looking at a range of asset classes that you might invest in. It's all in local currency. And we're showing the year-to-date return, the 1-year return, and the 3-year return. So, looking at this exhibit, we can see you have made money if you bought equities over the last 3 years. US stocks annualized almost 15% per annum. Let me go back there. Local stocks, Singapore equities, have been slightly negative. So you haven't made money if you bought Singapore equities, you have made money if you bought US equities. And what about gold, which we're focused on today? Gold has been the best performing major asset class year to date. We're going to talk in why that is, what drives gold, and why you might have it in your portfolio in a second. So what's been driving the markets this year? We think sort of 6 key things. The China economic slowdown, or emerging markets more broadly. As these economies slow down, company earnings potentially get under pressure, and that's spooked investors year to date. Earnings slowdown is a follow-on from that. Declining oil prices is an interesting one. I don't know many people who like it when oil prices are high. They like to be able to buy gas at a low price. So in a way that should be a good thing for consumers. In a way it's a tax cut. But what it does signal as well is that maybe the global economy is not growing as fast as it could, and there's not enough demand for oil. So that's been concerning investors as well. US interest rates, I've got a picture of Janet Yellen here. They're always in the news. What happens with US interest rates sort of sets the tone globally. And this one at the end here, President Donald Trump, just got a lot more likely this week, actually. Markets, generally speaking, don't like things that they can't model, or they don't know how it will impact the companies that they invest in. So President Donald Trump is a big unknown. Again, and you can't really model what he will do as a potential president. So definitely a range of factors that have been spooking the market. I would say from an investment point of view, most of you will invest your own portfolios. There's always going to be something to worry about. So it's very rare that you go down to your broker, invest money, and everything's fine, and it's been great for years on end. So you have to kind of get over that element. If you're going to be an investor, you probably want to be an investor for the long term, and you've got to accept the sort of rough with the smooth a bit. And so I'll just skip over this slide, but the thing about ETFs, there are so many of them, they cover a range of asset classes, as we talked about. But what's been the top selling ETF globally this year? It's been the SPDR Gold Shares ETF. So investors across the globe have added more than $7 billion into this gold ETF. And we'll talk about why people invest in gold now and how it might work in your portfolio. So the first thing about gold, who thinks gold is a risk-free asset? Put up your hand. So a few people, and I would say it shouldn't be viewed as a risk-free asset because its price actually moves quite a lot over time. So it's actually quite a volatile asset. If you think of a risk-free asset, risk-free means you hold it, it doesn't move, you know exactly what you get, it's guaranteed. Gold price tends to be much more volatile. So we like to think of gold as portfolio insurance. So it tends to do well when everything else doesn't do well. So from a total portfolio context, it has that nice characteristic of doing well when your other holdings are not doing well. The gold is also, and this is a chart that shows the correlation to some major equity markets. Correlation is just a fancy word. How does gold move relative to Japanese equities or relative to US equities? And from a portfolio perspective, to gain the benefits of diversification, you want things that are moving different to each other. You know, you don't want all of your portfolio to go up at one time and then all of it to go down at one time. You want things to be balancing it out. And gold is exactly that type of asset, in that it has either a negative correlation or no correlation at all to what's happening in equities. The other thing about gold is, as I sort of mentioned, is it has tended to do well when people get scared. When somebody invades somebody else, gold tends to do well. When there's a financial crisis, gold tends to do well. And we can see this in these exhibits here. So we're looking at the Gulf War, the first Gulf War, back most of those we don't need to dwell on them too much, but certainly interest rates. So one thing about gold is it does not give you any yield. So somebody like Warren Buffett he's perhaps, you know, the greatest investor there ever was, and he hates gold. He doesn't buy it because it doesn't generate a yield or an income. So he doesn't understand why you would have it in your portfolio. But generally speaking, when rates are very low, such as they are today, you're not sacrificing anything from a rate of return perspective by holding gold. In some countries, there are negative interest rates actually. So this has been a factor that's been driving the performance of gold as well. And you would expect to see that over time too. Final one here, flows also tend to drive the performance of gold. So when people get interested in gold, it tends to have a sort of self-fulfilling effect a bit, and that you get more investors coming towards the asset class. You tend to see it written up in newspapers, it's on CNBC, etc. So that is a positive driver of gold. So what's the long-term performance? So we launched the SPDR Gold Shares ETF back in 2004. Today it has about 35 billion in assets, and it's generated very solid long-term returns in US dollars here. Nice uptrend. But you can see a significant sell-off from the high in 2011. So it's not a risk-free asset, but it certainly is an insurance asset, and we can see a real turnaround in performance here at the beginning of the year. This is the long-term performance of gold. So if you had bought the SPDR Gold Shares when it launched back in 2004, almost 12 years ago now, your annualized return would have been a little over 9% per annum. So a very solid long-term return with some difficult years sort of thrown in the mix though. So where does the gold sit? What is the ETF? So, there are many ways you can get access to gold. You can get a certificate from a bank that tracks the price of gold. You could buy gold futures contracts. If you're buying the gold ETF, you get a share of a pile of gold that is custodied in London at the HSBC vault. So you get direct exposure to the physical asset. So if we go bankrupt, nothing happens to your investment. You still own a share of that gold. Now the Spider Gold shares, and the guys from DBS and various others can show you how to buy and sell this on the Singapore Exchange. It does trade throughout the day. The total expense ratio is 40 basis points, so 0.4%. And with that, you invest alongside some of the largest investors in the world, and you get access to physical gold within the ETF. So a great strategy. Again, from your portfolio context, how do you fit this in? We wouldn't recommend that you go out and buy 50% of your portfolio in gold. Gold should be viewed as an insurance or as a hedge against bad things happening, against too much money being printed and the like. So, anywhere up to about 10% of your portfolio might be a reasonable sort of starting point. And then you have that insurance. So when equities or there's some sort of financial crisis driving markets lower, you have the potential to have that balancing effect with gold in your portfolio. So it's a great diversifier. Don't rush out and buy 100% of your portfolio in gold. So, some people are very bullish on it at the moment and suggest you should have a significant allocation. But for us, just an allocation, 10% or so as portfolio insurance. Right, now we'll spend a couple of moments. I can probably take a pause. It's probably not the best room for questions, but if there is a question, feel free to raise your hand now. I'll just have a quick scan. Okay, so I'll be around afterwards at the DBS stand, so feel free to come and have a chat about the gold ETF. Before we sort of move on, a couple of other ETFs that we have trading on the Singapore Stock Exchange, the S&P 500 ETF. I mentioned earlier, that's the biggest ETF in the world, 180 billion or something. The expense ratio, 0.09%. Very low fees. And what does that give you? It gives you exposure to the 500 largest companies in the US, where it's done in a passive way, so we're not trying to beat the US equity market return. We're just giving you exposure to the US equity market in total. And that has been a great long-term investment over time. Obviously, we've had ups and downs, but over time, there have been few better wealth creation sort of tools than an investment in US equities. So what do you get as the ETF? So you give us $100, what does your portfolio look like? Well, it looks like the S&P 500 index. And in that index, you have some of the most dominant and famous companies in the world. So Apple, what we've been talking about earlier, Facebook, Amazon, etc. And it's broadly diversified across the full range of sectors. So you get great exposure to the US market and the global economy generally. And just a fantastic starting point for an investment in US equities. You could go out and try and choose 10 stocks, 15 stocks, which is fine. Or you could, go out and buy one ETF, charges you 9 basis points a year and get exposure to 500 stocks. We can see again the long-term results have been fantastic. Going back to the early 90s, 1993 when we launched this ETF, the annualized return investing in US equities is around about 9%. You know, I would say our expectations for future returns are a little more muted. You know, over the next 5 to 10 years, maybe something in the realm of 5 or 6 or 7%, but nonetheless a very attractive long-term investment proposition. Now, the final ETF that we're going to sort of talk about today is the Singapore ETF, the STI. So many of you will probably have this on your CPF account. Similar to the S&P 500, the SPDR Singapore or Straight Times Index ETF attempts to buy the entire market of Singapore. So we're not trying to beat the market, we're trying to provide investors with the returns of the market over time. And how have you know, Singapore equities done since we launched the fund back in the early 2000s? Did very well up till about 2007. Since the financial crash, while they've recovered, they really haven't moved much. It's been very range bound over the last few years. You'll all be familiar with that sort of trend. One of the reasons why Singapore equities have struggled a bit, I mean, Singapore as a country is incredibly strong and dynamic economy, you know, 1.9% unemployment or what have you. But the reason the Singapore equities have struggled is that they're very heavily weighted in a few sectors, particularly banks. So the last few years have been difficult for banks and financials, and Singapore obviously has a very significant banking sector, and that is reflected in the ETF that we're looking at here. Now, the good thing about buying Singapore equities today is they're relatively cheap. You can get almost 4% dividend yield buying Singapore stocks today. You know, compare that to your bank accounts or other options around the world. Very high dividend yield. If you look at some valuation characteristics, very cheap as well. Price to earnings, 12 times this year's earnings. So investing in Singapore equities via an ETF, you get the broad market. You're buying an asset class that's relatively cheap. Over the long term has done particularly well, but not great sentiment at the moment. And we can see here, going back since the inception of the ETF, almost 7% annualized return. Some very strong years. Last few years have been, you know, a bit difficult. So this ETF, again, very cost effective, 0.30% as a total expense ratio. So, you know, go out, if you use actively managed Singapore equity funds, compare the charges that you're paying and compare the performance of your actively managed fund to a passive ETF that it just attempts to track the market. And I think, you know, generally speaking, what we've found with investors is once they take a look at ETFs, once they sort of understand the principles of passive management, owning the whole market rather than just a few stocks, they really like what it is that they find. So maybe we can conclude here quickly. Some of you have heard about ETFs. Hopefully those that hadn't heard before this session sort of walk away with something, but they really have revolutionized investing today. They've brought cost-effective, institutional quality portfolio management to the masses. Again, If you guys give us $100, that is managed right next to a sovereign wealth fund who has $1 billion in the ETF. So you get that professional management. They're relatively straightforward to understand. Again, you can use them to buy broad exposure to an equity market or specific asset class exposure such as gold. Finalising the sort of case for gold, you know, we've seen the things that have been driving the markets year to date. There are always going to be things that investors have to worry about. It's never going to be all clear. If it is, it's probably time to get nervous. So having a small allocation to physical gold in your portfolio is a great way to have an insurance element within your portfolio. Listen, I hope this has been useful. I'll be around the DBS stand at the end of this for a few moments if there's any specific questions. We have a website that you can go and visit, spiders.com.sg, and DBS also has a great sort of booklet on investing in ETFs via their platform. So thanks very much for attending, and we'll see you later.